Folks, it's me again. I'm following up on my comments about the US financial crisis and how it affects Canadian banks. So just if we quickly recap, Silicon Valley Bank was around again for 40 years and had a significant run on its deposits, ultimately leading to its closure. So people say, hey, can what happened down there affect our Canadian banks? It's a much different scenario. Our Canadian banks, we only have 6 large banks. They're very tightly regulated. What happened with Silicon Valley is three key things. They had very concentrated customer base. They invested in long duration of fixed rate investments, and they didn't hedge their interest rates. Okay, so if you actually compare that to Canadian banks, they're much more diversified, and their capital, their tier 1 ratio capital is much greater. So when we look at the losses of Silicon Valley Bank, the loss on their actual short-term loan accounts were actually greater than the deposits, the liquid cash on hand to give back their investors. And it represented almost 111% of their liquid cash. When we compare that to the Canadian banks, our Canadian banks on average are 9%. Okay, roughly 10% of what Silicon Valley Bank is. And so they weathered the storm, and they have weathered the storm much more calmly. And when we look at the performance, we go back to that period of time, that roughly week to 2 weeks in March, where US banks, regional banks, and also big banks were down 20 to 25%. Most of our Canadian banks were down, single digits, 4 to 5 to 6%, which is partially as a result of what was going on in the financial sector, but also just the overall market trend over that period of time. So from my point of view, our banks are good quality. Yes, they may, experience ups and downs due to the uncertain nature of what's going on in some of these US banks. But over the long run, they're going to be well capitalized, very similar to 2008, 2009.